like I said, we're going to start accounting for long-term decision making today, otherwise known as investment appraisal. Okay. Investment appraisal, I mean, is a common thing that I'm sure some of you might have come across in your previous studies. Okay. It's, of course, very similar to the broad topic we just completed, accounting for short-term decision making. The only difference is investment appraisal relates to periods that are considered long. And in accounting, any period that is greater than 1 year is considered to be a long period. Okay? Right. So we're going to look at the following topics. We're going to look at, if we say investment appraisal, what do we mean by investment appraisal? We're going to look at the steps or the process we follow when we are taking investment decisions. Okay? We're going to look at investment appraisal techniques. Basically, the topics we're going to look at will be first, payback period, second, accounting rate of return, and the DCF techniques. The DCF techniques, that's the discounted cash flow techniques, includes the, of course, the NPV, the net present value method, and the internal rate of return method. Okay. The discounted payback period, we're not going to do that, even though it's part of this, because it's the same as payback period, but in this in discounted payback period, you discount the cash flows to today's values. Okay. So those are payback period, accounting rate of return. Okay, for today, naturally, we're going to, this is what we aim to do, the payback period, accounting rate of return. We're going to look at compounding, that's how to calculate the terminal value, and we're going to look at how to do discounting. Hopefully, if we finish this, that will give us a good background for us to attack our main topics under the DCF technique, that's the discounted cash flow techniques, that's the famous NPV and IRR. Okay. So this is what we're going to look at for today. Inshallah, let's try to save time. If I ask question, please unmute your mic and quickly answer so we can move, because I always want to make sure that I am communicating. So I'll ask questions. Please try and respond rapidly. Yeah. Good. So I have about 30 people. Good. Okay. So what do we think we're talking about when we say investment appraisal? Okay. Investment appraisal. What are we talking about?
Good afternoon, Mr. Fofana.
Afternoon, ma. Yes, go ahead. You want to answer, Cisse? Is it Cisse who was talking? Yes, you want to answer my question, please? Go ahead. Oh, you were only greeting. Okay. Right. So,
hello.
Yes. Yeah.
I want to take a try.
Yeah. Of course. This one you should not be given a trial. I don't want any textbook definition, please. These are simple things, and it affects our everyday life, whether we know it or not. Investment appraisal, simple English words.
Okay.
Yes.
This is, basically, this is the analysis you made to consider the profitability of an investment.
Okay. This is the analysis we do to check whether an investment is profitable or not? Very good. That's a good answer. Who can answer it in another way? But that's a good answer. Okay, investment appraisal. Okay, well, that was a good answer, right? So when we talk about appraisals, I'm sure for some of you who are working, something should come up into your head. And what is that? For some of you that are working, if you talk about appraisals, what is the first thing that comes to your head? Abdul Sise works for Trust Bank. Abdul, do you have any appraisal at all in Trust Bank? Okay, anybody who is working, if you talk about appraisal, what's the first thing that comes to your head? For those that are working at least? Staff appraisal. Don't you have staff appraisal in your various organizations? Or you know about staff appraisal? You know about staff appraisal? Hello, my people. You know about staff appraisals? Okay, anyway, I'm not getting any answer. If you talk about staff appraisal, you are talking about looking at each and every staff in an organization and try to analyze what they have been doing throughout the period, usually a full year, compared to their TOR, compared to their terms of reference. If your terms of reference includes preparing monthly bank recs, preparing your cash book, preparing your journal vouchers, and so on and so forth. If you are being appraised, you will be checked against those benchmarks or against your TOR. Your TOR, your terms of reference, serves as your benchmark. Okay? So staff appraisals means checking staff, trying to see whether they have been meeting what they are supposed to do, whether they are meeting the requirements of the organization as per their terms of reference. So when you talk about investment appraisal also, you're talking about checking, okay, evaluating investments to see whether they meet your requirement. What is your requirement? Your requirement is to make profits. Every businessman goes to business to make profits. So that's why investment appraisal will be checking or evaluating investments. And when you talk about investments, this time around is usually talking about more than 1 year, evaluating investment to ensure that they are profitable. Okay, profitable in the long term. Okay, so that's exactly what we are talking about. Okay, so some of those investment we can look at could include an investment in a plant. Okay, a plant is usually a big machine that is stationed at one place. Okay, for example, if let's say Sankun Sela, wants to go into the making of a toilet soap. Okay, they may want to buy a big machine that will manufacture toilet soap. Okay, but before they go ahead, they must do some analysis. So that analysis is what we call appraisals, to see if we buy this machine, what the machine is going to produce, are we going to make profits in the future or not? Okay. Another example will be an investment in a real estate. For example, common real estate, acquiring land that is going to bank for future sales. Okay. So this is very, very common in our country now. All the real estates are grabbing all our lands now. They are investing. So they are making investments. Okay. Because if you acquire, let's say, a big plot, let's say measuring 1,000 miles by 1,000 miles. Let's say you acquired it for, let's say, $20 million. Okay? You decide to leave this land for another 5 years. You're going to sell it in 5 years. That's going to get you more than, even twice, how to call it, that value. So it is an investment. Okay? It is an investment. So the next example we can look at as part of an investment appraisal could be a purchase of shares in a company. Okay, that is not very common in this country because we don't usually have any stock exchange markets. We don't have stock exchange market in the Gambia, but it's very common in other countries. Even staff, they are allowed to acquire shares of the companies they work for. Because I remember when I was in the UK, the last job I did before coming, I used to work for Vodafone, which is the second largest mobile phone company in the world. We were allowed to, acquire shares of the company. And then if you want to leave, you can dispose of your shares and then you make profits. Okay, so that's another form of investment. Okay. So I think we have an idea of what we're talking about, what are investments. So how do we go about taking investment decisions? Yeah? How will Sankonsila go ahead and, buy a new machine for making a new version of soap? And how will you as an individual, go ahead and think of acquiring shares in either the company you work for or in another company? Okay, and how do real estate companies, go about buying, land, for future sale? So any kind of investment that you want to go ahead with, at least you will follow, if not all the stages of all the 4 stages, but at least you will have to follow some of the stages. So the 4th stage is the origination of proposal. Okay, before you even think about anything, the idea must come from someone. Okay, usually in a business, it may come from our staff, it may come from the business owner. Oh yeah, now we are into producing only donkey soap. For your information, donkey soap is the soap that we use to wash our clothes and so on and so on. That's Armitage name. Somebody told me that he's from Armitage here. Is he in this class? I don't know whether he remembers that name or do they still call it the same name when he was there. I think it was this guy from Cora. Is Cora with us? He's not with us. Okay, fine. Yeah, so let's say Sankonsila is into production of donkey soap. Well, it's not for donkeys actually, but that's our Armitage name. And now they want to expand to toilet soap. Toilet soap is the soap that has got a nice scent that you can use to, wash your body and stuff like that, to have shower with and stuff, okay? So let's say they are into production of, donkey soap. I'll still call it donkey soap because I'm from Armitage, right? So they want to go into production of toilet soap. The idea must come from someone, okay? And maybe one of the staff will say, okay, but I've been to this other company, they're producing toilet soap and they're making a lot of money. Then, maybe that will be discussed at the corners and then until it gets to management, or maybe management can even come up with that proposal, okay? So there must be an origination of the idea or the proposal, okay? And let's say there are a couple of, proposals that's originated and then it has gone to the level of management. Okay, management can screen those proposals and try to select, the one that is, best, the one that is going to bring more income. They cannot just stop at, saying, okay, no, but instead of going for, you know, a tailored soap machine, maybe we should go for a machine that will produce plastic buckets or plastic kettles and so on and so forth. Okay, before they do that, they must go out, they must engage the accountants so that the accountants can do their appraisals, you know, and that's exactly what we're coming to do with our various techniques. Okay, so the project has to be screened until everybody agrees which one is more profitable. So during this screening process, that's when, you know, a particular one will be chosen and they can go to level 3. Level 3 will involve detailed analysis. Okay, maybe at level 2, we could use one technique, maybe that may be our payback period. And once we have a project that pays back quickly or whatever, then we can go to level 3 and do some, you know, detailed analysis. You know, now we'll say, okay, we have to use the NPV method also to see whether this actually is profitable. Okay, so level 3, there will be analysis, and then at this level, after a thorough analysis, there will be an acceptance. You know, the one that's the best among them will be chosen. And then, of course, implementation will start. Then at level 4, there will be monitoring and reviewing. Because if you start something, you must ensure that there is that, you know, M&E, there is that monitoring and evaluation process that needs to, you know, continue. So that you'll be able to know whether, in fact, what we taught in the first 3 stages is actually what is happening. Okay, so there will be monitoring and review. That will be a continuous thing until we know that, we come to know that this is exactly what we want. Okay? So, now that we know all that, we have got all our, we know all our steps, then, like I said to you, at stage 3, this is where the accountants will be involved. Hopefully, stage 2 and 3. Stage 2 maybe will do, you know, a high-level analysis. Let's say using how to call it the payback period. But in stage 3, there has to be detailed analysis using maybe NPV or IRR or any other method that will be chosen by management. Okay, so what we have to do in stage 2 and 3 is what we are coming to study as accountants. That is the techniques that we use in order to evaluate those investments. Okay, so we're going to look at investment appraisal techniques. Okay, so the methods we're going to look at, like I said to you, is payback period, accounting rate of return. Then we have the DCF techniques, the discounted cash flow techniques, which are 3. You have the discounted payback period and, discounted payback period, net present value method, and the IRR, the internal rate of return methods. Okay, so these are the ones that we have. Okay, so we're going to start with our payback period. Okay, we're going to start with our payback period. Any questions so far? So far, so good? You happy? Happy? Mariama, welcome.
Yes.
Mariama, yes. Mariama, were you on last class? Yesterday? I didn't see you yesterday. Mariama Ba. Hello, Mariama. I can't hear. I hope it's not network. Hadi also, were you in last class, Hadi? Yesterday, well, last class, it was only yesterday, actually. And Auntie Mary also, I don't think.
Good afternoon, Mr. Fofana.
Afternoon, Hadi, how are you doing?
Yeah.
You were on yesterday, yeah?
Alhamdulillah, I'm fine. Yeah, I started the class, but I was out, and then I had a low battery, so. Oh. But then I was in the last minute.
Okay. Is Auntie Mary with us now today?
But
yes. Good afternoon.
Auntie Mary, how are you doing?
I'm fine, thank you. Sorry, my screen had a problem. So yesterday the phone was at the mechanic. I just collected it this evening. That's the reason why I even joined lately.
Mary will tell you that you organized the class yesterday and we didn't see you, huh?
Honestly, billahi, my phone, I was so worried about this whole thing because what the stupid thing I did was I left the SIM card inside the phone and I left it with the mechanic. So I couldn't transfer it to this other phone in order to...
Okay, yeah, I can understand. That's okay, no problem. Okay, so let's look at the payback period. That payback period, yeah. Actually, let me just stop this video. I don't want the videos to be too long, actually.
Communicate that I will not be available.
Yeah,
so I have to download things and